In this podcast, I talked to Animesh Saxxon, who is a senior investment professional serving as managing director of Systematics, which is a multifamily office. He's currently based in London. And in our conversation, we talk about the similarities and differences between VBA and Python, both of which he and his team have used throughout his career. We talk about the different ways that he and his team have applied VBA and Python, most particularly to analyze structured products, complex derivatives, and to provide risk return profiles to his clients. And at the end of our conversation, we talk about Animesh's sister's work at Saxxon as director of quantitative research for foreign exchange derivatives. If that sounds interesting to you, then you're welcome to join us. You are calling from England, is that right?
That's correct. I'm based out of London.
London? Okay. Well, nice to talk to you. Nice to meet you. I reviewed your conversation with Gil, and I've been looking forward to speaking with you.
Likewise. Let's get it rolling.
Let's do it. So, from talking to Gil, we are essentially trying to understand PyPhi's mandate. I started this company back in 2018 after working as an investment banking analyst at Wells Fargo and designing a couple of machine learning algorithms, one of which was particularly useful for my team and our clients. So I left and I started teaching people in finance how to code, focusing on teaching machine learning to investment banking analysts and associates, scikit-learn algorithms, and also NumPy and Pandas, since those are involved. Since then, we've distributed our classes through distribution partners like Wall Street Oasis and Corporate Finance Institute. But since Gil joined back in 2021, we've been attempting to develop our own distribution channels so that we can work directly with our customers. But we found that, it's necessary for us to widen our scope beyond just investment banking analysts to serve people in FP&A, for example, or asset management. But I don't have experience in those sectors of finance. And I'm still continuing to learn about Python also. So we are talking to people like you who have experience in different areas, and we're attempting to answer the question, what exactly is the set of problems for which Python is the best solution? And who are the finance professionals that solve those problems in their jobs? So that's what we're after.
Yes, indeed. I think it's a very pertinent topic for finance professionals today, including the new gen millennials, as well as baby boomers like myself. I'm in my mid-40s, and during my college, we were coding in C++, and then in the early days on the investment side, I worked heavily with VBA, which is just another open source, not open source, but object-oriented language which Microsoft developed and integrated with Excel. So, but eventually Python came out and got adopted much more than VBA. Maybe because of it being open source, and there are a lot of libraries and functionalities, etc., which you can get around Python, which is limited in VBA because it's not open source. But yes, today I think Python is a very well accepted number one language in the world of investment banking for sure.
Mm-hmm. And could you tell me a little bit about your background?
Sure. So
and also how you've used Python in your work?
Yes. So my professional journey has been from an analyst to a chief investment officer in the last, let's say, 16 years. Being primarily on the buy side, working across funds and family offices. I also set up and led an asset management firm regulated by the Financial Services Regulatory Authority in UAE. Managed a lot of cross-asset portfolios, developed a lot of proprietary...
You said cross-asset what portfolios?
Cross-asset portfolios like across equities, bonds, structured products, and combinations of exposures. And that's where things start getting tricky when it comes to attribution or portfolio management.
I have a quick question. Sorry to interrupt. This is only tangential, but I've run across the term structured products, structured finance a couple of times recently. You just mentioned it. Could you please explain to me what that means?
So structured products basically are synthetic products which are not directly giving you the exposure to the underlying, but mirroring the return profile, and then you have scenarios of returns associated with those profiles. So I may own X amount of Apple stock, which is a long only position, or I could short them Apple stock, which is a short position. But structured products will give me a lot more flexibility to create different options, call options, put options, straddles, strangles, or various return profile. It could be that if the stock is between a range, I don't make money, but if it explodes outside that range, I make a lot of money. So those synthetic products are structured products, which are linked to an underlying. That underlying could be Apple. That underlying could be a basket of tech stocks such as FANG, which are listed. That underlying could be weather forecast as well. So in today's world, the underlying of derivatives, I think, is in trillions, which is, I think, it's anecdotal, but I think it exceeds the notional of the underlying in the derivatives world is far in excess of the world GDP as well. So you can imagine how much these structured products are used in today's world. And there are two kinds of usage of these structured products. One is to hedge. So there are a lot of currency, interest rate derivatives like swaps and whatnot, which hedges your exposure to the underlying. And then there are the speculators, which also take a bet on the movements of the underlying, which could be interest rates, stocks, anything that you can imagine. And that's what makes things more complicated, because when your portfolio has an open position, long position of Apple stock, and then you have a structured product which has a basket of, let's say, only two products, Microsoft and Apple. Now, how do I report my portfolio's exposure, my value at risk analysis, my average true range movements of the portfolio? So that is where the calculations and everything gets very tricky. And when I'm
More
entering into
complex.
these, yeah, very, very complex. And when I'm making the decision to add on a particular structured product which my private banker is trying to sell to me, I need to do my homework. So my analyst has to go and create a profile of the various scenarios that will happen, and we will have to look at historical data and then run the engine to see. Even the option pricing uses Black-Scholes formula. So when you are doing the pricing of these options, again you need to do heavy calculations. Otherwise, you might you might not negotiate well with the private bankers. So that is where a lot of calculations have to be done with a large amount of data. Now you can, and we did it mostly, and I told Gil about this as well, that a large part of my career we were doing it in when I was a junior analyst, I was doing it on VBA, because VBA is giving me almost identical capabilities as Python when it comes to the analytics. And we'll talk about the advantages of Python later. So if you will talk to professionals from my generation, they would have done their grinding in VBA, because it's so well augmented with Excel and even
And when you
Bloomberg.
say almost identical, you mean as far as it concerned the calculations that you were performing for your job,
Yes.
because wouldn't provide access to like machine learning algorithms or
Yes, true, of
analytics like
course.
that.
So when it comes to regressions and average true ranges and technical analysis, where you have a few technical indicators that you need to run on a historical data, or you need to do some simulations for the direction of the movement, and then you have to decide on when is your entry point or exit point, and then calculate what sort of returns it will generate, whether you code it in VBA or you code it in Python. There is I would say there is no distinct computational advantage that Python provides, except the fact that if I'm running um, the iterations with data which exceed 1 million data points, Excel doesn't have rows beyond it. So that is a natural capacity constraint of Excel, that beyond 1 million something exact, almost ballpark 1 million data set, Excel fails. Not only that, once your data set increases to a couple of hundreds of thousands of data points, then the file size also becomes very heavy, and then you need a really good laptop, with system power to make sure that it doesn't hang a lot, and it takes a lot of time to run the macros. So that's, I
Mm-hmm.
think, are the things that Python solves. It simplifies. You don't have to write a very detailed code and go into the variables and calculations and try to debug it. So they are very simple, and plus Python has some ready functions because of it being open source. There are so many functions that are there, which really reduces human effort into the coding that goes as far as VBA is concerned.
Because tools are already created. Okay. So structured products, tell me if I'm getting this right or getting it wrong. Would it be true to say that structured products are a subset of derivatives?
I mean, structured product as a definition is something which is structured and not a direct exposure. All right. And it
Mm-hmm.
uses derivatives such as futures or swaps and other um, securities which are linked to a future event with a strike price and an expiry date, and combines it into a contract. It's a contractual obligation. Okay, there is no exchange of,
Okay. And
there's no exchange of underlying security, basically. So
okay,
today,
so a structured product is not a security I can buy on a public exchange. It's something that I negotiate with a counterparty.
so it's a master is the contract that you have to sign. It's a contractual obligation, but there is no exchange of securities. For example, you and
Okay.
I can go and sign up for a call option on the stock, which is Apple, let's say, for example. Now, Apple is just the notional stock. It's not exchanging hands. I'm not selling you. You're not selling me. We are betting sort of on a few expiry date where a particular price, strike price, determines that whether I have the right to call that option or not. And if I call the option, then I get the upside for it. If I don't, then I'm already paying you the premium upfront for the right to be
Mm-hmm.
able to decide at a future date. So that's one, and
Okay,
that is.
so would you call that call option derivative a structured product?
Yes, yes, but
Yes.
structured products takes it to a next level. So I can bet on anything. I can bet on one outcome. I can bet on a combination of outcome. I can bet on equities. I can bet on a weather forecast. I can bet on some anything that can be quantitatively assessed at a future date. I can write a structured product for that and contractually sign master is the and other agreements between you as a regulated investment banker that is writing the option and me as a purchaser of that structured product.
Thank you for answering that question. And then concerning the calculations that you performed in your job as you were in the early stages of your career, you were able to do everything in VBA that you could now do in Python. You weren't constrained, like there was no analysis that you had to perform that you couldn't perform in VBA. But you're saying the difference is that Excel's data capacity is smaller and it's less computationally efficient. So if I'm working with large data sets, I might want to work with Python because a large amount of data isn't a problem, or highly complex calculations can be
Yes,
executed
yes,
more quickly.
yes. And I think the other advantage I would add to that is the visualization capabilities of Python, which is inherently lagged in Excel. But
You said
what
it's inherently what in Excel?
the data visualization capabilities. So now you have so many libraries, you have so many options to generate data visualizations after you run your calculations in the of the code. That that is where Excel and VBA lag behind in terms of how
Lag
the
behind.
data
Okay.
visualization.
Which is a function of Excel and VBA being developed by Microsoft, whereas Python libraries are uh, emerging all the time because they can be created by anybody.
Yes, so that is the main challenge of VBA. It's not open source. You can't, and I think I can give an example as to why Android killed Symbian way back in our days. Was because it was open source
What
and
is
it.
that?
So these are the operating systems for mobile phone, right? So Android killed Symbian, which was the old
Symbian?
or
I'm not familiar with
Symbian.
that one.
Symbian or BlackBerry OS, etc., because those were not open source. Of course, BlackBerry later on came to be open source and allowed apps to be developed on that platform. But I think um, VBA is not open source. Microsoft has no intention of making it open source because Excel still continues to be a monopoly in the world of finance. There is no alternative, and I think the market share is pretty big now in terms of the usage in the investment banking side. So, but we have seen how Nokia had Symbian as the operating system. By the way, Nokia and BlackBerry could not take on Android and Apple OS. Primarily because of this reason, but I mean that could happen to VBA as well. Python today, I was reading up before this interview, Python today is the second most used language after Java, because Java has a lot of other applications, non-finance applications as well. But Python is also being used in development of fintech apps as well. And when I spoke to Gil, I told that I've been involved in FP&A from a leadership level, not at a ground level, and there is massive potential of Python there as well, because of FP&A for complex industries such as construction, etc., requires very complex computations, which is currently being done manually or through the Excel VBA combination, but it's not adopted yet. There'll be a lot of cost savings for companies if they start using Python, like the investment bankers.
Maybe we can pick up on your career history. You were saying that you started in asset management firm in the UAE. Is that right?
Yes, that's correct. From the ground up, yeah.
And what happened next?
So we built a book around it. We got clients, and we were managing the portfolio of a few clients, where we were providing them with products from Saracen and Bank of Singapore as our booking centers, and a lot of structured products were being provided. And that's where we had a special team for structured products. The analysts were to run the analytics on these structured products, which these booking centers would give us, and we had to advise them to our clients. And when we are doing our advising, there is a lot of scenario analysis and computation around that specific structured product, so that we can draw out a very clear risk return profile to our clients. And that is what I tried to lead in asset management world, because today there is a lot of not mis-selling, but a lot of selling going on for structured products without the asset management guy, or the private banker with the asset management firm correctly understanding the product, and the client correctly understanding the product, which means that
Because they're complex.
It is complex, and which means that you could potentially missell, although there are a lot of checks and balances which the regulators tries to put in, but you would understand that the asset management business is relationship driven, and when it is relationships driven, the selling point needs checks and balances, and that can only be done when we have and the MiFID rules and other regulations are putting in this investor decks, the KITs, for the investors. Now, in order to prepare
KITs?
Yes, the knowledge and information documents, KIDs, for the investor for these products. So when you are making that as a private banker, you need to you need to explain the product and the risk return profile very clearly with the potential scenarios. And that is where we used to do a lot of analytics and prepare these visualizations, which I told you about, and our analysts used to do that. And Python was the main language to quickly churn around so many structured products that you're selling. There are monthly house views which comes from these bankers. We need to really run that exercise fairly quickly in a matter of 1 or 2 days. So that recursive thing requires heavy modeling.
And so are you saying that at this firm in the UAE, you were using Python, or were you still using VBA back then?
I used VBA during the time that I was the analyst associate, the guy who's doing the heavy lifting. But during my leadership level, at this point of time, I was the chief investment officer, so I was not doing the heavy lifting, but the team was relying heavily on Python to run the analytics.
Okay, so did you at some point make the decision to switch to Python, or did you start using Python as a firm because your analysts were skilled in it and that's what they chose to use as their tool?
So for particularly for the structured product, the hiring that we did was a French guy who has a natural inclination towards Python. Actually, see, for as a leader, it doesn't really matter what you want to use, as long as we have robust analysis and documentation which is professionally presented. You do it in VBA, you do it in Python, and Python is a middleware. And you would I wrote an email to you explaining how Python is used by my sister as well, and she does the same as well. In a lot of instances, the input and the output need to be in the archaic versions. So the input could be coming in a PDF, which is then converted into Excel or CSVs, etc. And that's the data input you have, which can then be augmented, and you can run the regressions or whatever analysis or backtesting, whatever you're doing with Python. And then the output itself is then generated as an Excel, which then you use, and you just snip it and put it in your either it's a research report or it's a product document for the client to invest in. So it really doesn't matter what you use. If I were to use, I would maybe be more inclined to use VBA, just for the fact that I've used it for several years. But a lot of today, my sister also validated that her work is 90% Python plus Excel, and that's it. It's very, very accepted. Another thing is that with GIT Hub and other platforms, you can actually share the code between your team members and others, and you can collaborate on a single sheet, which actually Google Sheets also does, but you can't do coding on Google Sheets. So of course there are capability issues which Python is solving.
As a leader, you didn't care what tool your analyst was using. You hired somebody from France who preferred to use Python. And as long as you got the output that you needed for your client, as long as the analysis was robust and the presentation was high quality, you were happy to use it. Was it a problem for you to audit the work of this person that you hired, since you had been using VBA in the past and were less familiar with Python? How did you solve that problem?
Yeah. So there were weekly sessions, and there is also a QPR process as well, which we maintained.
What process?
Which is a quality review process. Of course, my bandwidth didn't allow me to spend a lot of time, but with big clients and large ticket investments, we used to gather 3 people. One was myself, one is the private banker who's selling the product, and one is this guy Rashid, who was the analyst who was holding the pen on the analytics, and we used to discuss and agree on the product. So there was a sanity check on the work, but of course I'm not going to go into the code, right? So as long as the sanity check is working and we are doing some playing around with these scenarios, playing around with the average true ranges, etc., to see that whatever value at risk, etc., is being estimated is meeting the sanity tests. That's about it.
So you would meet, especially when the stakes were high, and check the output of this analyst's work.
Yes.
It seemed reasonable. You were comfortable trusting his work at a low level. It wasn't necessary for you to go line by line and audit everything that he wrote, which might not be the case for other people. Maybe in other cases, it would be necessary to audit the work at a lower level like that, but you were comfortable and he preferred to use that tool, and so you allowed him to use it.
Yes, and I'll tell you a reason why. Because we were EAMs, which is external asset manager. So we were not a full suite asset management firm, which is like Saracen or SocGen, for example. They are massive firms. They have massive staff, and they have their own risk management, like a huge risk management team, huge validation teams, etc. They can afford to have the maker and checker functionalities. We as a small EAM did not have that capabilities, but you are right, of course. Big firms, they continuously fine-tune, templatize, and improvise the codes that their team members are using.
Have you used Python in your work since then?
Very
or has
limited.
anybody on your team?
Very limited. Of course, my team has, but very limited. And that I told Gil as well, that you'll give me something, I'll go and code it with Python. You'll give me a set of outputs, etc., and inputs. I'll do that. My entire life from my college, C++. I think the only EX grade, which is an excellent grade, which I got in college, was C++, because I was a programmer by blood, and used VB a lot So the coder in me will do it, but 90% of my career I was using VBA.
Especially the junior part of your career where you were doing more
Yes, yes, yes,
low-level
yes.
analytics.
Yes,
Yeah.
and I'll give you an
Um,
instance as to how it all began, because one of my initial work was with KPMG. So and KPMG's transactional modeling requires a very simple code for plugging in the credit facility requirement, and which has nothing to do with the investment side, but it's something which breaks the model down, and you have to manually change every time, etc. And KPMG has a global knowledge hub back in India. Uh, so
it
I
has a
wrote a
global
code,
knowledge what?
hub. So it's like a back-end team of
Hub. Okay.
researchers and analysts, etc., which service all the global locations, including ours. So then I proposed that we should templatize it into a simple macro, and then there's a press button which will calculate the revolving credit facilities, and the model will get updated accordingly, instead of being manual and the client asking for different scenarios, what happens, etc. And you're not able to do that in a client meeting. And then what happened was that it was templatized for all the projects. So that is a very, very good example of even a big firm like KPMG adopting coding, whether it's VBA or Python for that matter, into transactional banking as well, or transaction advisory as well. So yeah. I mean, very rarely I've used Python, but today I think everybody is using Python when it comes to the juniors that are working.
So I'd love to hear about other applications. You described your analyst using Python for analytics related to these structured products so that you could explain them to your clients as you're recommending them.
Yes.
What other ways have your analysts on your teams used Python? Like what kinds of jobs have they done? And
Yes.
I'd love to know as many examples as you can give me so that I can understand the landscape of application,
Yes.
and also so that I can understand your business better since I don't have experience in it. Those would both be useful to me.
Yes.
And once we exhaust that, I would love to talk about your conversation with your sister too. And thank you, by the way, for having that.
Sure. Sure. So and this is something I discussed with Gil as well. He was trying to understand exactly, how we can pinpoint some use cases of the. See, I'll tell you, I still would say that it's the analytics part. The use case is the analytics part, and then the tool is either Python or VBA. And today there are only two which are competing. I think Python has exceeded the adoption in those use cases. So we'll discuss the use cases which are for the analytics, and then Python and VBA both can be used. Python has the advantages that we discussed, and Python is becoming more of a language that the younger generation is speaking now. But one of the things that where we used, and my analyst used Python and VBA both, is around the attribution analysis and around portfolio review. So I'll go back to my life before the asset management firm, which was with Finance House. We were managing a 1.4 billion portfolio, which is a sizable portfolio. And there was a lot of structured products coming in. There were like 400 million worth of equities portfolio, almost 400 million worth of bond portfolio. And it was a really, really complex cross asset portfolio. Now we have to do quarterly reporting. We have to do monthly reporting as well on the fast moving portfolio, which is the equities and structured products. But we have to do quarterly reporting to the board and the chairman, Mohammed Al Kubaisi. And what happens in that session is that we slice and dice the entire portfolio. We do a thorough risk management profiling of the portfolio. We show them in buckets what are the we segregate into trading portfolio and strategic portfolio, and then within those two portfolios we segregate the buckets of the themes that we are invested in. And for each one of them, we
And
have
just to
to
make
do.
sure I'm understanding the terms you're using, trading portfolio would be short-term positions, strategic would be long-term positions. Yeah.
Long.
Okay.
Yes, because they also have very different accounting treatments. And it becomes very important. Reporting becomes also very important from an accounting point of view, because bonuses and the overall optimism of performance and everything is linked to how we account for that. So and there is always this tug of war between the auditors and the investment people as to if we are fairly recording the portfolio in the books. So So for both of them, we have to slice and dice into themes. And when we slice and dice into themes, we have to drill it down to a security level. And that is where the maximum challenge happens, because we have to see that what is our true exposure of Apple. So one is I have direct stock. Okay,
Mm-hmm.
I'm owning 100 stocks of Apple. Then I'm having a structured product in which there is a basket, and one of the items in that basket is Apple. Then I'm invested in a mutual fund which has an exposure of Apple. So there are several exposure to a single security, and then I have
Mm-hmm.
also put it in a theme. For me, that is my tech theme or my listed tech theme, right? And and this creates computational challenges, because you have to make sure that all the data is analyzed properly. Then this is just taking stock, but we are not just taking stock, we are also profiling the risk. Where comes the value at risk? We have to go back into the historical data and see the average true range and some other parameters based on which we
You said the
can
average what range?
average true range, which is for every security. It's like statistical measures, like standard deviation. What is standard deviation? The likelihood of if you draw a normal curve, then it is the p-values, the probability of where the data set will lie. So which means that the historical data of Apple has to be taken, average true range, what is the one standard deviation level, what is the two standard deviation level, and what is the three standard deviation level as of today when I'm attributing, and what sort of exposure or loss will the portfolio hit if these extreme levels, 1 sigma, 2 sigma, and
And
3
so
sigma
is
are
this
achieved.
attribution analysis that you're describing?
Yes, this is attribution analysis, because
Because
see,
that's another term that I've seen in this space, but it's new to me since I
yeah,
haven't worked in it. So it would be, could you explain attribution analysis to me? Is like that,
yes.
is it basically what you're describing?
So see, at on a very high level and in a very funny way, attribution analysis tells you that how much is skill and how much is luck. Now, to make it a little bit more clear for the finance professionals, basically we are trying to attribute the alpha or the outperformance in different themes, because that is the only
Okay.
value add you are doing. If your portfolio performs exactly like the benchmark, then you have not added any value. You could have taken you could have invested in the benchmark itself. And
Mm-hmm.
for different portfolios, there is a risk return profile which is determined based on the client itself, right? That
Based on the client.
a lot of insurance companies or pension funds will have a very different risk return profile. They could be absolute
Oh,
targets, not benchmark, etc., because preservation is the objective there. So which means that when you are presenting your portfolio, you are first saying that what was my goal, and that goal cannot be it could be an absolute goal, but when it comes to attribution, you are basically trying to see that how much alpha or how much excess returns over whatever benchmarks were determined, composites were determined for my portfolio, I have achieved, and that's my outperformance. So that's
and
basically.
did you do that merely by taking more risk? Like, did you buy an ETF and lever up, or were you making better decisions?
No, so see, that is where the regression comes into the picture. That is where you now, if you're lucky and you invest in Bitcoin, right, and your portfolio doubles up, you would think that is a great performance. But if you will look at the drawdowns and you will calculate Sharpe ratios or Jensen's alpha and other such ratios, um, uh, information ratio, for example, you would see that it's a very highly risky portfolio. So the risk
Mm-hmm.
adjusted return is what you need to calculate, right? One person invests in a bond portfolio, other person invests in Bitcoin, right? You cannot just compare the returns on an absolute manner. You have to see that and that is where statistics comes into the picture. What is the volatility of that security? What are the standard deviation levels? What are the average true ranges, right? Can it wipe out my portfolio or a large part of this portfolio if I don't dynamically put my stop losses in place? The bond portfolio is very stable, right? So these all analysis requires a lot of data, and that is what we did at Finance House. Slice and dice, compare the historical, see that as with the statistical historical data and the regressions and the calculations of the Sharpe ratios, etc., how have my different themes performed? Because when
Mm-hmm.
I'm presenting, I have to not just present how it has performed, I have to also present that now what we are going to do. right? We like for example in finance house we had only the autonomy up to 10 million of trade, right, which we can execute. So if we are planning bigger, block trades, etc., we have to present our strategies and take the approvals. So for all this, lot of calculations happen, even on not just on the annual quarterly reporting, but for every single block trade that you are taking. um, and this is a
And a block
very
trade is a large trade, like more than $10 million.
yeah. So it's a block trade is, yeah, you cannot say 10 million. 10 million is just our authority level. But if we need a sizable block, now what happens is that, and when you are accumulating, you have to do a lot of shadow trades, because on the ladder you don't get everything at one price. There are sellers and they get wiped out. So today the stock price of Apple is quite listed, but let's say there is a low listed stock
Mm-hmm.
called Orange. So it is trading at 100, but as soon as I take 1 million shares, now there is nobody selling at 100,
Mm-hmm.
right? So the price goes
The
up to
price goes up.
105.
Mm-hmm.
Yeah, so I have to do my shadow trades and accumulate. And
And what are
I
shadow
read,
trades?
so shadow trades is that you do, you when you are on the Bloomberg terminal or on any market platform that you have, you would see that how many bids are there. So if the bid is only for 200 stocks, you purchase 199 stock,
Okay.
okay, or 150 stock or 100. So that level, price level remains. So more people will come into the ladder, and then you keep shadow trading. So you nobody can identify that somebody is buying really fast, because if
So
somebody is buying
shadow trading is making sure not to buy more than what is offered at the current price so that you're not
yes, so
increasing the
that
price of the asset.
yes, because in today's world there are
Huh.
so many algorithms also, and people who are very quickly able to identify buying and selling pressures, and then they change their levels of sell-offs or buy or bid or ask, basically based on those algorithms or observations by analysts, right? So we have to avoid that in order to secure the best price of that block trade.
I didn't realize that Bloomberg provided that kind of data.
Yes. Yes, yes. On Bloomberg during market hours, you will see the entire ladder. Every single person that puts a bid, you of course you need to integrate and pay fees for that market data,
Mm-hmm.
but that is available on Bloomberg, and that's why we had four
And
screens, five screens all the time, right?
mm, you're referring to the letter. Is that what you're saying?
Ladder. Yes, it is called ladder in the
Ladder, like a ladder you climb.
yes, it's the trading
Oh,
floor
okay.
language. Yeah. So and sometimes we used to go to the broker's floor as well, to be there, because broker's floor had all these LEDs on the walls, and instead of call, we can directly sit right next to the broker and ask him, okay, this trade is really important, so I'm going to tell you, you just keep buying. So that those are verbal orders, not phone or email to save. So that's the high action part of the profession. So, but I mean, let me go back. I mean, I got a bit digressed here, but let me
Yep.
go back to where all this has. All these are actions, but behind those actions, there is a lot of analytics and a lot of calculations that are going on at a very fast pace. Not just from the perspective of taking these decisions, but also from a reporting perspective, because we are always held hostage to internal audits where our decisions and our process will be questioned, particularly in case of finance house. It's a listed investment company, and you can actually see this 1.5 billion portfolio on the balance sheet of that listed entity, which is listed on ADX, the Abu Dhabi exchange. So with such reporting and compliance obligations, uh, every single deal ticket, uh, not the small ones, but the large ones, need to have a QPR or a quality review in place, and which requires a lot of
In
uh,
case something goes badly and that decision is questioned, so that you
yeah,
can
yeah.
say, here are the reasons why we made this decision.
Yes, 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 yes. That's exactly why a lot of computations are done. Not just, I mean, of course, you're saving yourself or protecting yourself with the explanation of why those trades were made, but it genuinely helps in taking the exposure. Particularly, like, let me go back to structured product. There is
Okay.
so much of mis-selling of structured product because it's just too complex for people to model it, and investment bankers, particularly the sales desk, where my sister used to work, by the way, take advantage of this, right?
Hmm.
So that's why it is very important that, particularly for structured products, whether you are purchasing it for yourself or you are recommending it to a client, there should always be a statistical analytics run around the risk return profile, and clearly understand the risk return profile, look at the historical information, and run analytics on it to be able to showcase the potential scenarios and risk profile of the product. I've actually scolded my team, and they have questioned me, and they've said, Animesh, I just placed 5 million. The client doesn't want to know. How does it matter? But it does, right? Otherwise, there are so many dialogues from the Wolf of Wall Street which we can quote, right? But that's not the kind of firm you want to build when it comes to asset management, and you have your fiduciary duty towards your client, or duty of care exists. So that's where a lot of analytics gets running, and the pen with which that analytics is run has now become Python.
Are there any other particular examples that you think would be good to share from your team, like particular applications, or do you think now would be a good time to talk about your conversation with your sister? I'd be happy with either one.
There are a few more
Please tell
applications.
me.
Um, I think we did the reporting and attribution side. That's one. We did the evaluation of the structured products. That two. The third is, and we didn't use it that much. We did use it a little bit. We did, and I think hedge funds definitely use it much more, is for developing the strategies. So when you are having, and there are a lot of short-term trading strategies, high frequency trading strategies, algorithmic trading which has come up.
What was that last one?
Algorithmic
Oh,
trading,
algorithmic.
yes. So, and we were using TA-LIB, and it's integrated with
What is that? I'm
Python.
not familiar.
Sorry. So it's a platform which is allowing you to do a lot of testing of your strategies, and trying to create a bot which can then be plugged into your broker. And now the bot can be plugged directly to the exchange as well, basically for rule-based trading.
And what is that called again?
Rule-based trading.
But what was the platform?
TA-LIB. Yeah.
TA-LIB? Okay,
Yes.
got it.
So, and this we achieved in Finance House, where we dedicated a small portfolio for this medium. I wouldn't call it high frequency, because for high frequency you have to be augmented onto the exchange directly, but medium frequency trading, in which we were looking at a lot of um, statistical parameters which we had developed. For example, there are standard Bollinger Bands, and I'm getting a bit technical, but there are standard Bollinger Bands, but you can change the parameters and develop your own Bollinger Bands, which is basically telling you how much far from the moving averages is your security right now, right? And which is showing that how, so think of it as a rubber band, how much the rubber band is stretched. And if you follow the mean reversion theory, it has to come back, right? Now this could be going on a curve upwards, or going on a curve downwards, but the rubber band is stretching and going down. So if we have to take advantage of this cycle, we need to know the levels, and the levels can only be assessed from the historical data, and that historical data has to be put into a rule with 9 different indicators. Now, if I have to simulate that performance, there is no other way that I can do than with a very powerful computational tool, which is where Python is used. And now what has happened is a lot of user-friendly platforms have come up, which have been created using Python, but they are giving you a front end to build this. Like even our dormant trading, which was our broker in the US, it has on its platform interface where you can develop those bots or algorithmic trading rules, because they are using Python to let you design that for you. So I think this is a
And
very
so, are you using these tools or potentially Python to identify the right. I guess I
Rules.
don't understand exactly what you're accomplishing. Like you're developing the rules, or are you back
Yes.
testing the performance?
No, we
Yeah,
are
both.
developing the rules. So that is why it is one level above back testing. Back testing is just that you say that this is the rule. Now back test and tell
Uh huh.
me that whether this rule works or not, which is a very one-dimensional analysis. And this is continuously going on. And of course, um, Python is used for that analytics. But we also need to see we have 1,000 different products on Chicago Mercantile Exchange. And we have different strategies. Now we have to check that what strategy could work on which of those securities. So it's a combination which is sort of smartly eliminating. So it's like like a binomial tree, right? Once you take a decision, you eliminate everything under the other one, right? So
Okay.
on one side you have all the securities on CME, for example, whether it's livestock derivatives or agri commodities or whatever it is. Those are those securities. Then you have 9 or 10 indicators based on what you have developed, that these are the indicators that I need to look at, but I have to look at some combinations. Then I define my rules that if this combination works, then you go and check if this combination is working. Then you check this combination is working. And if that triangle is getting completed, which means that there is a first validation of a strategy that can be applied on this particular security, which could be a livestock like feeder cattle derivative. So, and maybe I'm getting a bit confusing to the audience here,
Well,
but basically,
let me reflect that back at you to make sure I'm following. You're talking about designing an indicator that is, or maybe like a signal that's a combination of indicators that
yes,
would
yes, but
signal
but
that now is a good time to buy or sell a stock or some
yes,
other security?
yes, but a human cannot possibly do it because there will be like millions of combinations, and you don't know which strategy is being used, is working for a particular security. So this Python lets you, or VBA for instance, those codes are letting you optimize uh, and not check those million scenarios, but based on your initial results, you then go in the right direction. And that is where we applied. I'll give you an example. On Chicago Mercantile Exchange, for a single product, let's say feeder cattle, there are 12 to 18 contracts, 1 month later, 2 months later, 3 months later, 12 months later, up to 15 months later. Then there are calendars of these, which are combinations of two. Then there are butterflies of these, which are combinations of three. So for a single product, there are so many combinations of products which you can invest in. And this is just feeder cattle. Then there is live cattle, lean hog, coffee, cocoa, bean, etc. All of these have a very different cycle when their contract is issued, right? So, and this is what hedge funds do, particularly the commodity pool based hedge funds. They find out these strategies, what is working when, because this is the technical investment. Maybe China puts a ban on, or swine flu happens, and the lean hogs prices shoot up or down. This is fundamental analysis, but pure technical quant driven hedge fund strategies are basically doing all these computations and making sure that whatever the rubber band stretches because of these fundamental reasons, quantitatively I am riding that wave whichever direction it be in. And for that kind of computation you need massive amount of analytical horsepower, which has to be done by either platforms which are built on Python or Python itself, if you have the capabilities in house. So that's one topic I really
Here's
wanted to touch in this podcast.
the economic value of, let's say, buying the stock of a company that you believe is going to succeed is that you decrease the cost of capital for that company so that they can more easily finance the projects that they're working on. So in that way, investing provides economic value by allowing those companies to do what will hopefully be valuable work. What do you think is the economic value of this kind of quantitative investing? That's less obvious to me. Is it anything more than providing liquidity, or maybe smoothing out volatility, I guess?
See, so
Because I would imagine that if the algorithms or the rules are making accurate predictions, maybe that would mean that the price would be less volatile over time, because when some uh, meaningless volatility emerges, uh, meaning when the price changes in a way that is not reflective of the value of the company, like in the short term, some short-term trader can recognize that and make a trade in the opposite direction, and maybe that would smooth out the price, and maybe that's beneficial somehow, and also that provides more liquidity to the market, so that if somebody wants to buy, there's somebody to sell, and vice versa. I don't know. What are your thoughts?
so see if you, I mean, I'll, I can only give you an anecdotal answer to this, but I'll try to give you an example. You know, we saw the, and I can give it because I have seen the 90s, the 2000s as a student, and then the the global financial crisis as a young professional, and then the oil crisis, 2016, then the pandemic. So we have seen these cycles where the markets have really um, gotten volatile, and VIX, as you know, is an indicator which will tell you um, what sort of volatility the market is going through, and through these cycles, once you've gone through, I think history keeps making the same mistakes, uh, which is very well put by, I think, George Soros in his book Irrational Exuberance, and that keeps happening, I think, and that's what I kept telling my team also, that there are only two enemies uh, for an investment person: fear and greed. Both of them are your
Hmm.
enemies, because that leads to decisions, investment decisions that you may regret. Now, the economic value of the investment process, as you pointed out, is very, very dependent on the kind of firm you are, whether you are a pension fund or you are a hedge fund, which means whether you are an aggressive, it's like, for example, in chess players, some are very, very aggressive chess players like Mikhail Tal, who said that I will not accept a draw is not a result of a chess game. And then there were other defensive players as well. So it also depends on the nature of the firm. A hedge fund who wants to experiment and wants to create massive alpha, like Renaissance Technologies, if you will see, it doesn't sound like a hedge fund, but for the last 3-4 decades, they have generated 35% plus IRR. You can look it up on Wikipedia as well. They
Hmm.
only hire PhDs and data scientists and whatnot, because they are
Mm-hmm.
so passionately embedded in the ecosystem of these intense computations that and their performance has proven it also. But we have seen other hedge funds fall down significantly. Massive companies like Banyan Tree, etc., fell down due to excessive leverage during the pandemic as well. So I can't give you a very clear answer to it, but I think the economic value of these computational tools such as Python, or having a very robust and comprehensive analytical process behind investment decisions, creates immense value for hedge funds, where the alpha is entirely dependent on the accuracy and robustness of what is developed, which is partly driven by the horse, which is Python, and the jockey, which is the resource or the data scientist that you hire to work on. And that has time and again created winners and losers in these economic cycles. There will always be losers who took excessive risks or did not understand the risks that they were taking in the cycles to come as well. We saw it in the Great Depression so many years ago, when then Warren Buffett and Benjamin Graham came. Benjamin Graham then wrote the book The Intelligent Investor. So these learnings have been passed on from generation to generation. But still, we will see economic cycles, and we will see winners and losers coming out of it. I think the only constant will remain the good jockeys and the good horses, and that's where finance professionals, Python professionals and Python as a language and data scientists come together in this ecosystem. That's all I wanted to say. We can now discuss about my sister's role if you want. So my sister, most of the time, she worked initially in city in Hong Kong, and then she moved to London with SocGen. She was in on the structuring desk, particularly for FX, where she was providing structured products for their clients who wanted to take had some hedging or otherwise speculative objectives around the FX asset class, which is the forex asset class. Um, and now she is director of the quantitative research at SocGen, where her role is purely the quantitative analysis of the products that they offer to the clients. So this is what their role is. This is what her role is, and as I told you, 90% of her work is Python plus Excel plus little bit of Bloomberg, because that is the data source for all the computations. And so I would say that, and this is not just her, but anybody on the investment banking structured product quantitative side would be just living through day in day out Python platforms. I've written a more detailed email to you where she told me a lot of use cases around backtesting and visualizations, etc. If there's anything specifically you want me to talk about, I'll be happy to tell you.
I'd love to discuss all of it as much as you can. Yeah, tell me everything.
See, in terms of you wanted to understand what are the tasks that she does that involves Python. It's like for SocGen has to publish internally for its clients and otherwise on their house views lot of systematic trading strategies. So the computation and the backtesting of the various signals for developing these strategies are done using Python. So that's one. And then there is a lot of performance analytics that has to be done in terms of calculating the risk return profile, basically the volatility or the embedded risk, standard deviations, etc. And she also mentioned about Sharpe ratios. So all these performance analytics is done using codes written in Python. Then there is optimization.
And so backtesting explains why they decided to pursue a certain strategy, and then performance analytics tell you how those strategies did?
Yes. So backtesting is basically confirming the hypothesis that the trading strategy has worked in the past and generated X amount of returns.
Mm-hmm.
Okay, but
when you're performing backtesting, I imagine you're probably testing how a strategy would perform at many different windows of time. Is that true?
Yes. So it depends on both, on the strategy. If it is a short-term strategy, so you are basically looking at hourly or daily data sets and running it for a brief period of time, let's say 12 months, etc. But if it is a medium-term strategy or even long-term strategies, then you have to look at a window of 5 to 10 years, but then you are using a different period interval for the data sets. But essentially, yes, backtesting is confirming hypothesis around 4 or 5 parameters. After that, then once you have the winners, then you are doing the performance analytics of the strategies on the real-time basis as well as on simulation. So there are two things that you are doing. You are simulating the portfolio, and you are maybe the product has been live for, let's say, the last 12 months. So you're doing a lot of analytics on that performance of that particular strategy of that portfolio.
She's using Python for backtesting. She's using it for performance analytics.
Yes.
And why is she choosing to do this with Python instead of Excel? Is it because she's using large amounts of data?
So I asked her this question, and her response basically was that Python is much more easier than that coding in VBA. Because there are so many predefined functions, etc., which makes your life very easy, and you can accomplish much faster. So that's one. Second, she said that this sharing the code, multiple people coming on to the platform, which is GitHub, that makes life very easy. It's like what Dropbox did to file sharing, and Google Sheets did for managing centralized information, etc. She did mention very clearly that Python is the standard language in quant research now. So I'm quoting her when I'm saying this, and it's it's it is compatible with so many data sources that it makes life very very easy to use Python. So that was some of the reasons that she talked about. You also, if you go to Jupyter Notebook or even PyCharm, so you debugging is much much easier in Python based platforms than it is in Excel macros platform, the Microsoft platform, because you cannot run a part of the code. PyCharm allows you to run part of the code and debug in chunks. That also she was mentioning that it makes your life very very easy.
Okay.
Yeah. But one of the things that she did highlight was that in many circumstances, the reliance on Excel is there on the two ends of the process, which is the input side and the output side. Input side, there are a lot of data which is stored by the client in Excel format or PDF format, which then has to be imported into the choice of your platform. So that's one. And second is that the output sometimes also has to be in Excel for ease of reference of the end user or the ultimate user, which could be a client or your internal reporting purposes, where you are taking the snippets out of those output files and putting them in your monthly house views, etc., etc. So many a times Python is the middleware, the computational middleware, with the input and the output being in Excel.
So you're, yeah, got it. Okay.
She did also talk about visualizations. So she does a lot. She generates a lot of data for tables and plotting of charts for the SocGen publications, because SocGen publishes a lot of reports on a monthly, quarterly basis. She travels to a lot of conferences where they have to provide thought leadership in the world of quant. So these kind of thought leadership activities requires a lot of work on the computational side, where she uses Python.
Why would she use Python for visualization instead of Excel? Did you talk to her about that?
So see, the thing is, I didn't discuss this in detail with her, but I can provide you my own views around this. I think there are a lot of augmented side products which make visualization very easy.
Packages,
exactly. So with Excel, the challenge is that it's not a unified environment. Microsoft has tried to unify it as much as possible between PowerPoint and Excel. But if you are using Illustrator or maybe other suites which are much more designer friendly than PowerPoint, then that sort of compatibility issues are there. So these packages provide you with, I think, a much better designer version and compatibility of the visualizations that are being created using them than Excel. Excel is very old. Even today, if you have to create a lot of charts and graphs, it's very time consuming, you would appreciate. So I think that's I think that this Python packages are much more chic and designer, and much more user friendly and much more agile than Excel, I would say.
Okay. Is there anything else that you discussed with your sister that you think is worth talking about?
I mean, nothing that comes to my mind right now. But yeah, that's what mainly she said.
Well, that's all I have for you, Animesh. This has been a nice conversation. Any other comments before we go?
No, it was very interesting conversation. I think that the audience have some key takeaways from this session. And yeah, thank you for having me here.
That's all for today. Thanks for watching. And if you like the video, please give it a like. If you want to see more, subscribe, and I'll see you in the next one.